Welcome to this video where we compute the average return on investment for a project lasting 10 periods. We have the estimated net operating profits after taxes for each year and the pro forma book values for each year starting from 0 to 10. At time 10 the book value is 0 because the project is over. Let us calculate the discount factor. For 0 it is 1, and for 1 is 1 divided by 1 plus the cost of capital. The cost of capital is assumed to be 15%. So we have 0.87, the discount factor for year 1. Then we copy the formula and we have the discount factors for each year. Now I've made an error. Yes, I have to fix E4 and then I can copy. Okay, that's correct. Now, as shown in the previous video, we have to calculate the present value of all the incomes, of all the profits. We use the sum product function. In array 1 we place all the incomes from 0 to 10. In array 2 we place the discount factors from 0 to 10. Okay, we click OK, and we have the total return in present value. This is the present value of the incomes, of the estimated incomes. Then we make the same operation with the book value. Array 1, book values from 0 to 10. Array 2, the discount factors from 0 to 10. Okay, and we get the total capital invested. We divide the total return in present value by the total capital in present value, and we have the return, the instantaneous return on investment. And we get 39.6%. To get the annual return on investment, we just have to multiply this rate by 1 plus cost of capital. And then we find again what we have found in the previous videos. The project's rate of return is 45.5%. The NPV can be calculated as the total capital times the excess return, which is the difference between the return on investment, the discrete annual return on investment, and the cost of capital discounted by 1 period. 1 plus cost of capital. And this is it. The project creates value, and we have computed the net present value without even making recourse to the cash flows. Obviously we can compute the cash flows. The first cash flow is minus the first initial capital. The cash flow at time 1 is given by the income 375 minus the change in capital 400 minus 600, and we get the cash flow at time 1. It is 575. Then I just copy the formulas and get all the project's cash flows. Now we can compute the NPV starting from the cash flows. by discounting the cash flows at 15%. Then what we can do is just use again the sum product function. All the cash flows from 0 to 10, and in array 2 all the discount factors, and we get back what we have already computed, the NPV 475.05. Let us compute again the rate of return. It suffices to compute the total return, the total capital, divide total return by total capital in present value, and then multiply by 1 plus the cost of capital. So again, sum product, the incomes from 0 to 10. In array 2, the discount factors from 0 to 10. Okay, and we get the total return in present value. Same sum product, same with the book values. All book values. Array 1. Then array 2, the discount factors from 0 to 10. Click on OK, and we get the total capital. We just have to divide these numbers and then multiply by 1 plus cost of capital. We can get an intermediate rate of return, which is the instantaneous rate of return, as dividing present value of incomes by the present value of book values, and the discrete return on investment, the project's rate of return, is the instantaneous rate of return times 1 plus the cost of capital. This rate of return, 45.5%, is compared with the cost of capital. It is greater than the cost of capital, so the project creates value. The excess return is, let us write, excess return is the difference between 45.5% and 15%. This is 30.5%. The investors get 30.5% more than they would earn if they invested in the market at 15%. Here is excess return. And the NPV, and the NPV is just the multiplication of the total capital invested at an excess return of an annual excess return rate equal to 30.5% divided by 1 plus the cost of capital. And this is the net gain for the investors.